Most beginner traders make the mistake of jumping into the big names. They want to start trading options contracts on Tesla, Nvidia, Apple, Microsoft, Amazon, SPX, SPY, and QQQ. And partly it's because these are the tickers that everybody is talking about. But here's the problem. Those tickers can move very, very fast. And the options contracts can also be very, very expensive. And if you don't know what you're doing, you're still new to options trading, one bad entry can wipe out your confidence and your account at the same time. So in this video, I want to talk about a ticker that does not get enough attention in my opinion, but that could be a really good ticker for a beginner options trader. And this ticker is IWM. IWM is the iShares Russell 2000 ETF. It tracks small cap US stocks and it gives traders exposure to nearly 2,000 companies all in one ETF. It has an expense ratio of 0.19%, and some of its top holdings include Bloom Energy, Applied Digital, and Credo Technology. And by the end of this video, I want to show you exactly why I recommend IWM as your go-to ETF when you're starting your options trading journey. Remember, the views in this videos are my own, and this video is intended to educate. So before you actually make an investment decision, I also highly recommend that you seek the advice of a professional and also you do your own analysis. Let's start with the basics. Like I said before, IWM is an ETF and it tracks the Russell 2000. And what that basically means is that it is a basket of small cap US companies in this ETF that you can invest in. So instead of you trading one individual company like Tesla or Nvidia, where news, earnings, lawsuits, product launches, CEO comments, analyst upgrades can suddenly move the stock, IWM gives you broader exposure to that group of companies, right? So it helps with the diversification and it reduces the impact of one company. So that's important because trading single stock options can be very, very dangerous because one headline can destroy your setup. One earnings report can blow your trade. One news event can send the contract premiums through the roof, and if it's moving against you, you could find your account in a very, very vulnerable position. With IWM, you're still trading movement, but you're trading an ETF and not just one company. So I really hope as a beginner trader, you really understand this point because it is a very, very powerful point. For options traders who are new to the game, the contracts for SPY, QQQ, SPX tend to be more expensive than IWM. And for this reason, that's the first reason, I believe that IWM should be top of your list in terms of consideration. Because if you're starting out, what you want to do is you want to start out with options contracts that don't really hurt your account. So being able to buy options contracts that are more accessible for a small account, I think it matters a lot. And that is probably the biggest reason I think you need to consider IWM. Because when you're new, you should not be risking huge amounts of money while you're learning and trying to master the concept. Because the biggest trap when you're trading options is that you risk big and then you lose a lot of money and then it affects your confidence and you might not be able to come back and trade with confidence again. So your first goal as an options trader when you're learning is not to make money. I'm a firm believer that your first goal while trading options is to survive long enough to learn and master the skill. So using options contracts that are a little bit cheaper, it enables you to learn without always needing to take oversized risks. Now, the second reason that I think IWM is good for new traders is IWM is powerful when it comes to liquidity. And liquidity matters because when you buy an options contract, you will eventually need to sell it. And if you're trading an asset that doesn't really have liquidity, the bid to ask spread could be wide, meaning that the difference between your bid price and your ask price is too wide. And you would find that sometimes when you actually enter a trade with a huge bid to ask ratio, you're already losing money the moment you enter the trade. And that's why I tell people when you're starting to trade, don't just look at the chart, because some people just look at the technical analysis and they want to enter. You also want to look at the options chain. And that's why understanding delta, gamma, theta, and the bid to ask spread is very, very important for you to study. Now, because IWM is an actively traded ETF, their options contracts tend to have really good daily volume. Not as much as SPY, QQQ, and SPX, but enough strong daily volume that enables the bid to ask spread to be very, very tight. And that's what I like about IWM. The liquidity is there, and it enables you to trade your options contracts, get in and out quite easily. Again, this does not guarantee profit, but what it does, it helps reduce some of the friction that beginner traders often don't even know they're dealing with when they start their trading journey. I'm not saying that IWM is perfect ticker, because I don't want anyone watching this video to think that IWM is some magic ticker. It's not. IWM options can still lose value very, very quickly. Small cap companies can be very, very volatile. Your options contracts can decay fast as well. Bad entries can still hurt you. Over trading can destroy you. And if you're trading with money you cannot afford to lose, you should not be trading options at all, period. What I am saying is you need to develop a plan. You need to have proper position sizing. You need to go into your trade understanding your daily loss limit. You need to journal. You need to know your setup before you even enter. So all of the good principles, all of the rules that you need to have as an options trader still apply with IWM. But what I am saying is that IWM is beginner friendly compared to some of the other options products out there. But what I'm not saying is that it is beginner proof. So you need to respect your risk management, you need to respect your rules, and you need to follow all the other good things you're going to do as an options trader anyway. So to summarize, what I'm saying is that IWM is probably one of the best ETFs for beginners because it gives you a really good, strong combination of liquidity, price movement, and more accessible pricing. From my analysis of IWM, it does give you really clean market structure. And it also has the ETF diversification by having the 2,000 small cap companies in it. It's not the only ticker you can trade. It is not a guaranteed winner, but if you're new and you're trying to build a skill, IWM, I think, is absolutely worth studying. Instead of you jumping from ticker to ticker every single day, I would encourage you to spend maybe the next 30, 60, 90 days just watching and paper trading IWM if you don't use your real money first. Mark, the levels every single day. Track how it behaves. Study the option chain. Journal the setups and review the entries and exits, and also the profitability you'd have made when you'd have taken the exit. Because that's how you're going to improve, and also that's how you're going to really come to the conclusion that what I'm saying, does it actually make sense? And remember, the goal as an options trader is not for you to get lucky on one trade. The goal is to become someone who is consistently profitable, and consistency comes from you following the process. If you found this video helpful and useful, make sure you subscribe to the channel. I love to deliver content that helps traders become better traders every single day. And also remember, every 2 weeks, I hold an options trading bootcamp where we dive deeper into options trading. The link for that is in the description, and there are more links in the description of ways that I can help you become a better trader. So I hope to see you guys on the other side. Take care.